Glad you are with us on the Retirement Compass. Brad Johansen, Tim Kulhanek, and Jeremy Gove, Stonebridge Wealth Systems. Good to be back with you guys.
Yeah, you as well.
We're all good?
We're
good.
We're good.
It's like a winning streak, right?
It is.
We all want to be on a winning streak. If you've been in the market, you've been on a winning streak. As a matter of fact, it's such a winning streak. Market has been above 15% for 3 consecutive years. Okay, how rare is this? Since 1926, 8th time, guys.
That's it.
That this has ever happened. S&P 500 up 26.3% in 23, 25% in 24, 17.5% in 25. That's a nice run.
Feels good.
Recency bias. We're all good, right? How rare is it that we've had a run like this?
Yeah, since 1926. So we got 100 years of the modern era market data that we can kind of look back and analyze. And this is only the 8th time that it's happened in history. And in fact, I got a chart that I'll pull up here and show you just how rare this is. So we had 23, 24, 25. Brad, you laid it out pretty good there. That's a 3-year average of 23.1%, which is right in line with what we've seen historically, about 26%, or 26% is what those have looked like in the past. And the question everyone's asking, what happens next?
Yeah. Yeah.
And the reality is we've got history on it. We just don't know because it's pretty darn mixed. What happened next? There are other 7 times this has happened. 4 times it went up double-digit gains, looked great. 3 times the market declined. Average return the following year still looked pretty good, 12.3%. So what does that mean for 2026? It means stay tuned. We'll find out. Soon
Okay. I'm staying tuned.
Yeah.
Natural question. What happens the year after the streaks end? You give us that idea, but we all want a crystal ball, Jeremy. You got this whole thing figured out for 2026?
I would say no, I do not have it figured out. The thing, I guess the thing that everybody needs to understand is, as Tim mentioned, it's been 4 of the 7 times the market went up that 4th year. 3 of the times the market went down, including 2000. That was the last time that the market went down after a gain like that. It was down 9.1%, right? The average return for the year following these streaks was 12.3%, which actually is above the long-term average of 9 point whatever it is. 10, yeah, right around 10. So the key takeaway is there's no real reliable way to forecast what's going to happen. The underlying, the importance of the underlying fundamentals is really more important than trying to guess what the market's going to do. Because if we are trying to guess, we're really gambling, and we're not investing the way that makes sense for our situation. And so the underlying fundamentals are the corporate earnings, the economic growth that we're seeing, the interest rates, and those are all the key things that we really should be looking at.
Yeah.
Okay, if we get the key things, I'm not sure, Tim, we actually even focus on key things. We focus on emotion. Yeah. It's been good, it's been good, it's been good. We have a bunch of us who are going to go, it's going to keep being good. Everything tells us it's going to keep being good. Yeah. I like it being good, so it's going to be good. Yeah. The other part are people who are going, man, we got to have a crash. Yeah. It can't keep going like this. So we end up in the worry, and we talk about the psychological of this all the time. Yeah. Should I be worried?
No, you shouldn't be worried because the market's up 70% of the time. So the market, a lot of times people will try to compare the stock market to a casino. Casino, you ain't winning 70% of the time, okay?
Heck no.
I've never left the boat with anything in my pocket. Maybe one time, the first time I ever went there.
What do they say? The best gamblers win 51% of the time?
That's right.
Yeah.
That's it.
I was in Vegas one time, got a ride from a guy driving a taxi, and I said, what do you do for a living? He goes, well, I'm a professional gambler. I'm like, well, what, you're driving a taxi? And he goes, I'm a professional gambler. So here's a couple things to consider. Separating emotion from data is critical, but that's really, it's way easier said than done. And that's why having an objective third party to bounce your ideas off of and be able to be that kind of buffer zone between you and your panic,
right,
is really critical. If we actually take a step back, high level, I was looking this up the other day, from an economic expansion perspective, this current economic expansion is actually by recent standards, not too recent, like we're talking about 3 years. I'm talking about since 1982. By recent standards, it's pretty young, right? Since 1982, the average economic expansion in the United States of America has been 104 months. We're sitting at 70. So I'm not panicking. The other thing that we have to keep in mind is stock market returns vary quite a bit. We always hear about the owl average is 10%. How often does it actually return 10%? I've got a slide I'm going to show you, and we're going to answer that question.
Okay.
And the answer is not very often. Stocks usually don't return their average. If you look at stocks, they rarely finish around their average. This is 100 years. Again, that's what we have. A long-term average is around, like Jeremy said, around 10%. But that average of around 10%, 8 to 12, only 6 out of 100, right? So hardly ever. 38 are great. 20, not so good. But you can see it still averages a really darn good return. So patience is the key, and not being like, I sometimes say that people get the Edward Smith type of syndrome. Do you know who that is? Have you ever heard of Edward Smith?
Yeah, I have.
Guy that was cruising in the Titanic that one time.
I've heard of that guy.
And what was the problem? Did he know that there weren't enough lifeboats? Sure. Did he know there wasn't enough, life vests or whatever? Well, at least they said that on the movie. Did he know that there was a chance that there was icebergs out in the North Atlantic on a moonless night in April? Sure. Did he slow down and take his time and be more careful and patient? No. Why? Because he thought the Titanic was what?
Indestructible.
Indestructible, unsinkable, whatever word you want to use. Sometimes people get to be like that with their investment portfolio, and they never rebalance. Stocks are running, bonds have been flat, so instead of being a 60-40, they're an 80-20, and they just say, oh, well, I'm going to let that keep going, and they don't do the discipline things, which is why it's important to have that impartial third-party perspective, like a seasoned advisor that's a holistic planner that can give you perspective and be like, hey, look, you've already won the game. There's no reason to be throwing it across the middle when you're up in the fourth quarter.
So if I'm an investor, Jeremy, what do I take away from all the numbers? A lot of numbers.
There's a lot of numbers, and the simple example or the simple takeaway, I guess, is that markets are unpredictable in the short term. You want to be invested for the long term, and you want to be invested according to the risk that you can take, right? And sometimes that's how much can we take emotionally, but it's also how much can we take, based on what we have and what our goals and objectives are. So over the long periods, 10, 20, 30 years, the stocks have delivered that average return of about 10%. So staying invested is key. The key also is having that diversified portfolio and constantly be, maybe not constantly, but at least quarterly or semi-annually, you want to be continuing to rebalance that so that you're going to have winners and they're going to take off, but you want to make sure that the other investments that you have are balancing that out because they will perform at some point, or they might be there to help absorb. When the market is turning down, you want to have that protection as well.
You guys study, which you're specialists, which is
Right.
why we want somebody who studies. Tim, we like headlines.
Oh, yeah.
Give me headlines, and just give me the headline. Give me some headlines on this that we ought to pay attention to.
Well, I'll give you a sobering stat. During 2025, we saw 13 days where the S&P was either up 2% or down 2%. And history would tell us that if there's more than 10, that's usually kind of a red flag. But most of that volatility and weakness came in March and April. However, if you allowed yourself to be emotionally driven out of the market during that volatility, let's say you just missed the 10 best days in 2025, and you're investing just for simple math in the S&P 500 index, in an index fund. If you stayed invested the whole time, you had 17.9%. If you missed the 10 best days, you know how you did, Jeremy? Any idea?
I think you lost money.
You lost over 10%.
Goodness.
10 days. Okay, there's 250 some odd trading days. So why does this happen? So we had clients, not very many, because they know how we operate, and we know that we take a long-term approach focused on long-term goals, not letting the short-term noise, derail us from our strategy. But when they saw headlines like I'm going to pull up here, a few people get concerned. Is sell USA? Why Trump's tariffs may be sparking historic storm on Wall Street. Tank the stock market. Did you panic and sell? Hopefully you didn't. Hopefully you had an experienced, comprehensive approach, balanced approach to retirement, working with a trusted advisor like the experienced advisors here at Stonebridge. Because just a few weeks later, this is one of the shortest drops in the market we've seen, by late May, the Monday morning quarterbacks had arrived, and they said a little bit different tune. They said this. They said, if you sold, you may have lost $7.6 trillion by allowing yourself to be panicked out of the market. The stocks just erased the tariff-driven losses, posted the longest winning streak in 20 years. Look, here's the deal, folks. At Stonebridge, we don't build portfolios to try to buy winners. We're not trying to find a needle in a haystack. Instead, buy the whole haystack, right? And build a portfolio designed more like a Humvee than like a Mazda Miata. Something that's got reinforced doors, dual suspension, run flats that will get you home behind friendly lines safely when the storms come. That's how we design your portfolio. We'd invite you to reach out to us at the number at the bottom of your screen so you can maybe get a second opinion on what you're doing. And if you got a little bit nervous, or maybe you've made some mistakes in the past that you feel like, shoot, that was a missed opportunity. Look, let's not let it compound. Let's just fix it. Give us a call today.
You know, if you think about the average American consumer, we don't talk about financial topics very often. And so we spend a lot of time at Stonebridge doing educational seminars and different things that are free of charge. If you're not educated in a topic, how do you make educated decisions? When you're working with a client, you're sitting down with them, they're a little stressed out, but after you go through the process and you really take time to educate them on not only what we're doing for them, but why we're doing it, that really gives them peace of mind, and you can see the weight just kind of drops. And when they leave, I hear all the time,
I really should have done this years ago. But sometimes there's a fear that somebody might try to sell us something. If the things that I can provide, if you don't want, don't need, or can't use those, I've got some good news for you. We're not going to sell them to you. We are fulfilling our fiduciary duty of putting their interests ahead of our own.
Glad you're with us on the Retirement Compass. Brad Johansen, Tim Kulhanek, Jeremy Gove, Stonebridge Wealth Systems, and we're talking about the market. We love the market, right? But at your retirement, you need to adjust, and we need to figure that out. We're kind of digging into some of the numbers because we've had 3 great years. Last year, Tim, we go up 17.9%. But let's dive in tech-wise.
Yeah.
Did tech drive? What are we up 24%? Give me the disparaging number, and it's not disparaging, but what is between this gap of 17.9 and 24, and why are techs driving that?
Yeah, I think the most obvious answer is just like we had in like the late 90s, early 2000s of kind of the tech craze that was based off of the invention of the internet.
Yeah.
Now it's the next thing, which is this AI-driven expansion. And so absolutely, if you look at the numbers, I got a chart here to kind of explain it. Over the past 5 years, tech stocks have averaged 20%, which is great, right? Over the past 10 years, it's 24%, so it looks even better. Now you compare that to the S&P 500, which, you know, the S&P 500, it's a market cap weighted index. So the biggest companies take up the biggest amount of space, which tend to be tech stocks right now. But we have seen a little bit of a broadening out as far as the main players, if you will. So in other words, in 2023, all 7 of the Magnificent 7 stocks outperformed the S&P 500. In 2024, I think it was 6 out of 7. In 2025, it was actually only 2 out of the 7. Kind of interesting, right?
Yeah.
So more players. You have, again, we call that market breadth, where more, rising tide is lifting more boats.
Stock valuations. Too high. I mean, if you're going to hear investors say that, is that a logical thing to say? Man, we've been riding so well. Our valuation's too high.
Yeah, they are high. I think if you look at the end of 2025, the technology stocks were trading at a price to earnings ratio of 39, which historically that is high. That's elevated, but there's no question. But it's nowhere near the peak we saw in March of 2000 when tech stocks hit a price to earnings ratio of 52. But what's different, Brad, is right now we have tech companies that actually have earnings. Back in 2000, they didn't have any earnings. Everybody was buying their stock with this hope that this is the next best thing. And we saw some were winners and some weren't. Companies like Apple, Microsoft, NVIDIA, Amazon, they're generating huge amounts of cash every year. And so the valuation is elevated, but is it a concern right now? I'm not sure that I would call it a concern right now because their earnings are astronomical.
Did we get into this point, Tim, of talking about concentration risk? Because everybody wants to ride hot. I want to ride hot, so put me in the stuff that's hot right now. Is there a concentration risk with that?
Yeah, no question. And even just if all you're doing is using a very passive model, that might be all right during your accumulation years when you're still climbing the mountain because you've got time on your side. But there's a reason why, time is either your greatest ally or your biggest enemy. Because once you start pulling that cruise ship into the harbor of retirement, a whole different set of risks occur, right? Or appear, right? When you're out on the open ocean during your accumulation or your working years, like there's really not much that can go wrong. There just isn't. You get in closer to the harbor and all of a sudden you've got all these cables, a lot of stuff under the water you can't see, rocks, sunken ships, other traffic that's coming and going. And there's a reason why as you get closer to retirement, it's kind of like as you get closer to the harbor. You have to have a harbor captain pilot come aboard who's an expert in navigating this more complex type of area. So when I talk about concentration risk, like the S&P 500 right now, I mentioned earlier, I said market cap weighted. The top 10 stocks probably take up, right now, I'd guess it's between 35 and 40% of the index. So the S&P 490 only gets about 60%, and the S&P 10, so to speak, gets about 40. So you're almost going all in on about 10 stocks, and if those 10 stocks have trouble like they did in 2022, then it's not going to look very good because you're basically using size as a strategy and just hoping that the biggest companies continue to do well. But that's not a balanced, comprehensive approach.
Coming into the harbor is kind of what we're talking about with retirement, is that we've got to navigate this a little bit more. And people worry about the history. We got the book out in 1929. Let's look back. We start looking at .com bubble when we start hearing AI. What's your final take on where we go as this technology seems to be rocketing day by day?
I think the estimates I guess the technology isn't going to go away. There's new developments literally every day. The challenge is it's moving much faster. So the change that's happening is much faster. The estimates for data centers and demand through 2030 for that growth rate is going to be between 19 and 22% per year going through 2030, just for data centers. So what does a data center need? It needs servers, it needs space, it needs cooling, right? It needs a lot of electricity. So there's a lot of things that we can use or look at and say, okay, if that growth is going to be at that level, maybe there's some other things that can go along with the technology stocks. But the artificial intelligence, cloud computing, that transformation, those trends, and realistically, they have years, if not decades, to run just because we don't even know how far they will go, right? And so in 2022, though, we did see a major decline with the Magnificent Seven that Tim mentioned earlier. Yeah. They dropped 40%. So it is very volatile. So that's why we don't want to put all our eggs in that basket, but having a little bit of exposure to is probably not a bad idea depending on somebody's risk tolerance.
And understanding how to navigate that into the harbor is kind of what we talk about all of the time, that this is different than all of your wealth accumulation. And many of you have been with wealth accumulation advisors and done very well. We highlighted it at the beginning. You've had 3 consecutive years over 15%. If you've been with a wealth advisor, you should have made money. Now we're coming into the harbor, you need a specialist to be able to take you safely in and understand how we're navigating this next part of the waters. 866-256-7778. Let's put together a complimentary written financial plan for you. Or maybe you're thinking about, I need to adjust. It's time for a second opinion. 866-256-7778. Let's do that. We'll wrap this up when we come back.
Crossing the open ocean takes a strong captain. Some days the sea is calm, other days storms rise, but a good captain keeps the crew steady and the ship on course. As the harbor approaches, everything changes. The water is shallow, the channels are tight, and tides and currents shift. and unseen rocks wait below the surface. That's when the harbor pilot comes aboard. Their one job is to get the ship home safely. Hi, I'm Jeremy Gove with Stonebridge Well Systems, and your financial journey is no different. You've crossed the ocean of your career, but retirement is the harbor, with new challenges like taxes, Social Security timing, and healthcare costs. At Stonebridge Well Systems, we know how to guide families safely to shore. Call the number below to schedule your complimentary retirement strategy session.
So glad you're with us on the Retirement Compass. We're talking about market changes, and that's a constant. How are we navigating in 2026? I want to go into the bond market, Jeremy. Take me through what happened in 2025 with bonds.
So bonds actually had a really good year. They were up 7.3%. That's well above their historical average of 5%. What's interesting about bonds is they tend to have returns closer to their average. If you go back to 1926, bonds have landed in the 0 to 7% average range 59 out of 100 times. So bonds they're not going to be a home run. They're not going to be up 20% in a year. They're going to stay closer to that average. They have had returns above 10%, but that's happened 12 times since 1926. So that's not a big hope. The thing that I think is interesting about bonds is if you can picture a teeter-totter, if interest rates are going up, bond prices are going to go down.
Yeah.
If interest rates are going down, bond prices are going to go up. So what's been happening, what happened in 2025 with interest rates? They went down. So we would expect those to go up, right? And so we're talking about potentially lowering interest rates again. And so if that happens, bond prices, it should be a decent place to invest until the Fed decides to start raising interest rates. Then we would maybe want to reallocate that.
We got a new Fed chair.
Yep.
And I don't know whether you know, but Donald Trump likes people to do what he wants done, which means
Really?
He wants interest rates to drop.
Go down.
Which would tell us that we're going to have interest rates. Take me through interest rates, why we should pay attention to that right now.
It's really, I think a lot of times we try to overcomplicate investing.
Yeah.
If you look at the stock market, it's really supply and demand. If more people are buying, prices go up. If companies are profitable, prices go up. If more people are selling, prices go down. If companies lose money, prices go down. Well, bonds, you can look at the yield at the beginning of the decade, and I've got a chart that I'm going to show you here, but you can look at the yield at the beginning of the decade. It's a pretty good indicator of where we're at. So at the end of 2025, the current yield, on the 10-year Treasury was 4.2%, okay? And if you look at where we've been historically, like the 40s and 50s were terrible. Interest rates were artificially suppressed. 2010s, right after 2008, they called it ZIRP, zero interest rate policy. That's why it says near zero. Bonds actually averaged a little bit higher during that time period because they had been higher. They came down. Jeremy told you about the teeter-totter. So if rates, let's just use the word reset, they're around 4.2% going into 2026, all you really have to do, historically speaking, is say, okay, well, beginning of this decade, this next 10-year period, rates are around 4.2. Bond prices are going to fluctuate, but bonds, if you look at the aggregate bond or average bond, are probably going to do around 4%. So we actually have a lot of data on this. It's not overcomplicated. Now, is there still diversification and things we want to do, make sure we have different categories, not put all of our eggs in one basket? Sure, but bonds aren't designed to be the growth engine in your portfolio. It's designed to be more of a stabilizing effect on your portfolio. But there's things that we can do outside of that so we can further spread out the risk and not be too concentrated.
Simplify it again. Economic expansion, Jeremy, relatively young historically speaking. What does that actually mean for us?
Well, so our economy it's just like you have spring, fall, winter, summer. It's cycles, right? And the economic cycles consist of expansions, as you just mentioned, Brad. That means our economy is growing. We also have recessions. That's when it's contracting, right? The average recession typically lasts, or since 1926 has lasted about a year. 12.6 months is the exact number. So a recession is typically much shorter than the expansion cycle. The average expansion cycle during that same time frame has lasted over 5 years, or about 61 months. But since 1982, expansions have averaged more than 8 years, or 104 months. So the current expansion started in April of 2020. So we're about 4.5 years into that. And so that means by historical standards, we could have several more years of economic growth ahead. Or if we could potentially have a recession. But again, the recessions are shorter lasting, typically going back historically.
We're doing a lot because there's a lot to take in, which is why we talk about specialists. There are market insights that you guys have been paying attention to, and it's not even on a daily. It's sometimes for you guys a minute by minute thing on the day. Give me some key takeaways that I want our viewers to have as we move into this, because we are searching for somebody who has their hand on the pulse of what's going on right now.
I want to go back to something that Jeremy just said. You talked about the cyclical or seasonal nature of the economy.
Mm-hmm.
Your investing it's the same thing. There's seasons to every phase of life, right? Sometimes it's spring and you see new growth and new opportunities and new ideas to invest in. Sometimes it's summer and everything just seems to be like it's greening up and everything's nice and it's smooth sailing. Sometimes it's fall, it's time to harvest maybe. It's time to prune back some different growth. It could be time to harvest some gains, tax loss harvest, rebalance your portfolio. Sometimes it's winter, right? And things look barren and you look at your portfolio and you start wondering, did I do something wrong? Have I made a mistake? But far too often what I see investors do is they try to uproot their financial tree in the middle of winter. And if you do that, every time you do that, you're never getting a chance to grow deep roots and bear real fruit. So if you're at home right now and you're wondering, oh man, I'm worried about the market. Do I need to make a change? Should I move money out, move money in? I'm gonna tell you this, just take a step back, take a deep breath. Don't uproot that tree yet. Instead, call that number. Visit with one of our experienced advisors and we'll walk through your unique financial situation and see how we can help.
So to put together a complimentary written financial plan that is yours, that will take you through the seasons. And hopefully you've got a lot of them into your retirement. So let's put it together now. Use your time wisely to do something for yourself. Make the call, 866-256-7778, and scan the QR code as well. But you need to move on this. Let's see you in the office. We're grateful you've been watching. Now we want to see you put together your plan. And we'll be right back here next time on the Retirement Compass.